The results, I think this first slide is probably for me one of the most important, and that is actually really what we're focusing on. Two aspects of people. The one is the client, really understanding the client and satisfying the needs of the client. And then the other one, it's just as important as our people working for the bank, unlocking their full potential. And I think if you add those two together, then you're creating shareholders' value. If you look at our key indicators, I think everyone has seen our key indicators. Our earnings per share up with 20%, return on investment 27%. Remember, we're focusing on that 25%, so we are 2% higher, and I'll elaborate on that a little bit later in the presentation, what we're doing on that particular end. But yeah, we're very pleased with the results. I think if you look at the results overall, there's basically 3 areas or 4 areas that is focused on. The first one, tremendous growth in client numbers. We're still getting 109,000 clients per month. On a gross basis, it's around about 140,000. So we're still growing very strongly in the client numbers. And I think it's coming back to that first point. It's that simplicity, value, and transparency of the Capitec offer in the economic climate that we are. That is actually creating that value for the clients. Then we've seen a very strong growth in transactional, on our transactional income. Very much driven by self-help, where people are actually going and helping themselves. If you look at the app, we've got 1.8 million people on the app. We've got over 3 million people on USSD in the branches. We've got self-help devices. And for me, the very nice positive of that is it actually enables our consultants to actually service our clients much better, actually really sit with a client and spend quality time with a client and really informing what Global One is all about, really understanding the app. So when that client is actually moving away, he's actually a brand ambassador, because I think that's the strongest marketing you can get is word of mouth. So the whole self-help strategy has helped a lot. And then on the credit side, I think we've made the right decisions last year. We told you that we've cut back, and you can see it in the sales numbers. We're basically flat. We're actually slightly negative if you take out the credit card. But that's the way we saw the economy, where we cut back, and I will elaborate again on that, and also focus on what we're doing in the next couple of months. And then the credit card, I think we're quite pleased with it. And probably the last one is Funeral was launched, and I will elaborate on that. So I think of the last 6 months, there were some other things that kept us busy. I'm not going to talk about that, but we're actually quite pleased about the overall result. I think if you look at the key indicators and you look at the results, unfortunately, we had to bring in IFRS 9. It takes you a while to actually understand IFRS 9, but I think it's important if you look at IFRS 9. 2 things that I want to highlight is if you're a 3rd month in arrears, then you must reflect it on net interest and not gross income, gross interest as before. So what it's actually stating is on your interest line, we are 442 million lower. So if you want to compare apples with apples, you need to add it. Then your provision, also you need to make that adjustment. And then we've always, on the credit life side, we've always sort of put the income on top and the tax at the bottom. The accounting principle says now the tax needs to be at the top. So what you're seeing is there's that adjustment of 142 million that's been made that has actually moved from your tax to the top end. So you need to look at, whenever you do any ratios, you need to make those 2 adjustments to really understand the figures. So that's the effect on the cost to income. You can see if you just purely do a cost to income, you get to a 38%. But if you make the adjustment, as I'll explain, then you're on 36%, in line with our expectations. Our operating expenses increased with 11%, in line with our expectations. And yeah, you've seen the top end line predominantly growing through our transactional income. I think that was probably the surprise for everyone. Everyone thought it's going to go up, but nobody thought it would go from 41% to 47%. We're aiming for 50%. I think if you're going to add funeral in the future, it definitely can go to 50%. And then the $1 million question is what's going to happen with the credit side. But currently, everyone is keeping credit fairly flat, given the economy. But as you open up credit, your credit income will grow, and then this ratio will change. So just take that in consideration. But I think if we can get to a 50%, that will be good. I think the main message here is the fact that we are now well diversified, that we're not 100% dependent on credit income anymore. And yeah, that's the other nice one. We said we want to cover 100% of our OPEX through transactional income. We're now at 90%. We said to ourselves, 2022, we want to be at 100%. Hopefully we'll do that much quicker. But I think that's a very nice figure to show that we're covering now basically our full OPEX is being covered now with transactional income. The South African landscape, I'm not going to talk about all the negative things. I think everyone knows about inflation and exchange rates, etc., etc. I think what I did here is just a bit of a reflection on what has happened in the last couple of months. We all know that President Ramaphosa was elected in December. I think one of the key things is in very key positions, you could reappoint Nene and Provan Gordon. I think that's fairly positive. The SARS commissioner were replaced. We're waiting for a final announcement on it, but I think that's positive. The SOE boards were completely reappointed, and I think there's one of the big things that's actually taking us, this whole tender process has been stopped. Board members are not allowed to be in it again. So it will take time. We spent some time with the SOEs, with Minister Nene and Provan Gordon, and the thing that everyone is looking now is for a proper business plan on SAL, Eskom, etc., etc. And that's what these boards need to do. The National Prosecutor Association authority has been replaced, and we're starting to see foreign investment coming in, and we're starting to see, he announced a plan on Friday, and I think the two messages or two focus areas for me is, I think what we need now in South Africa, firstly, is clarity. Because if there's clear clarity and everyone knows exactly what needs to happen, then we can produce. And then secondly, I think it's very important that government, politicians, and the private sector actually works together and to see how we can actually get this country to grow. I've stated in media yesterday and before, I think what we should focus on is radical growth. Because if we grow the country, then we will change a lot of things in South Africa. I think this is just a bit of a reflection on South Africa, to understand South Africa. It's to me a worrying figure, social grants. If you look at the 57 million people in South Africa, 17 million is social grants. Formally employed is 10 million people. I think the scary figure for me is if you look at people earning more than 20,000 Rand per month, there's only 2 million. And if you look at SARS figures that came out on Monday, they confirmed these figures by saying that there's only 1.7 million people earning more than 25,000 Rand. 70% of South Africans are earning below 5,000 Rand. So we need to understand the South African context. We're debating it quite a lot in our strategic sessions. Where do you focus on? What is the South African economy looking at? What is the typical population looking like? And where do you need to offer value? So I think we need to understand the South African contents. The worrying figure for me on this is concerning, again, looking at South Africa, is if you look at that age below 19, 21 million people below the age of 19 and 17 million people below the age of 14. I think the scary thing is these people are, as they're getting 18, 19, 20, they need jobs, they need a future, and they need to know where they're going. So I think that is a big challenge that we need to fix in South Africa. I think what it also tells you is our market share, because it's now difficult to do market share comparisons. Everyone is asking the 10.5 million, where can the 10.5 go to? I think what you're seeing here for us, what's positive is if you go and look at the age group between 55 and 64, we've got a 27% market share in that particular age group. So you can see how we're entering the people above 40. And then on the higher income side, we've seen very strong growth. But I think it just gives you a bit of a context of the South African landscape. Banking, yeah, I think the 10.5 million clients, basically up 1.3 million from last year, August. We're very pleased with that number. The number that we're actually focusing on is the banking clients. So that's where there's inflow into the accounts, and that's at 4.9 million. What we're tracing is the different income bands, and we're seeing much more stronger growth in our above 15,000 level. And you can see that in the number of transactions, because the higher the income is, the more transactions the people are doing. If I look at, for example, the app, over a 6-month period, the number of transactions per person per month has increased from 12 to 15, and that just shows you how the higher income people are just transacting more and more. And then we're sitting with 1.3 million credit lines, and you can see that dip in the credit lines as we pulled back in line with our credit strategy. Transaction volumes up 27%. If you look at self-help in total, up 25%. On our ATMs, an increase of 14%. That's one of our big focus areas, is to say how can we actually move people away from cash and move people to card or self-help devices. Cash is a very expensive item. It's one of the big contributing cost factors in our OPEX. And then you can see the branch volumes going down with 4%. So everything nicely in line with the different strategies we've got. And I think this gives you a bit of a overview. You can see there on card versus cash, 57% is now card, 43% is cash. We were at 60% in August. So that's a figure that we are starting to drive very strongly to see how we can get people to behave differently and use their cards. We've got a lot of direct marketing communication to people to encourage them to use their card. You can see on our self-help devices in branch, 84% of our transactions now is performed on self-help devices, strong growth of 74%. The app usage, our number of transactions we've done in August was 30 million. So very strong growth. So I think on the whole self-help or self-service, we've done exceptionally well. It's one of the surprises. I don't thought, if you compare South Africa to Europe, the financial literacy levels is much higher in those particular areas. But we're sitting with a much younger population, and it's much easier to turn that younger population to self-help. On the safe side, our retail deposits, you can see on the blue line, around about February, that dip we had with the reports that came out. But we had strong growth of 22%. For the last 2 years on our retail fixed, we didn't advertise at all. We started with that about 3 months ago, and we're starting to see growth of 300, 400, 500 million per month. So very much in line. I think that reflects the trust in the brand, which is very positive for ourselves. And then on the wholesale side, we're managing that. We went to market this, I think it was in May. We raised 500 million. We were oversubscribed with 1.9 billion. So we're just keeping in that market to make certain that if we want to go into that market, that it's available and people still understand the business. So from a funding side, we well funded, and you all know the capital adequacy is at 36%. So we're quite happy in that particular area. Then the one that everyone is looking for, the numbers on the insurer side. It's still early days. We're selling now 2,000 policies per day. We sometimes on peak days we go up to 5,000. So we're doing quite well in that particular area. We should be close to 200,000 policies by the end of September. But it's quite easy to sell. The other thing is to collect and to really understand it. So there's a big focus now on making certain that we understand the collection and the repayment of the particular clients. We've seen in the market that a lot of competitors has adjusted their benefits. So we're re-looking at our benefits, but we for sure still 30% lower on the market. Maybe just the other interesting stat is 30% of our sales is on the app and 70% is in branch, also in line with our expectations. So the funeral side, so far so good, but it's still very early days. The income on funeral is under other at 6 million rand, so it's still very small. So one will have to wait and see what comes through in the next couple of months. If I look at just 2 examples of clients, you can see here a particular client paid 845 rand per month. He switched to ourselves, and for the same benefits, he's now paying 338. We're picking up numerous examples like this in the market, and what is quite nice is when we're actually working with that particular client and showing the funeral benefits and the saving there, plus he's saving if he switches his bank account, you've got a double sell, which is quite positive, and we're picking up quite a lot of conversions out of this process. And then, yeah, you also got people that unfortunately need to claim, and you can see in this particular case, the payout was within 3 hours. Our time that we set ourselves is that all payments need to be done within 4 hours. So far, so good. So the funeral side, I think we're quite positive about. I think on the credit side, I think that's where the market is a little bit more difficult. I put this up because I thought it was quite interesting to see everyone is asking us the question, why are we not growing on the credit side? What is the opportunities? You can see the dark blue line, that one there, that's unsecured. You can see mortgages is the red, but basically from 2014, there's basically no growth. And it's in line with basically what's happening in the economy, so it's actually very flat. If you look at that mortgage figure, that growth is mortgages above 750,000. It's not in below. If you look at the demand in South Africa, the demand, I believe, if you go into Soweto, I was the other day in Soweto, and one of the things I did was to look at properties that's been advertised, just to look at average prices, and the average prices is about 500,000, because that's actually where the real market is taking place. But I think the message is, you can see from 2014, there's not a lot of growth in this particular market. I think the one positive, everyone is always saying people are over indebted. I think after 2013, 14, you can see everyone is tightened, and I think a nice number is to see that people that's current, and remember this is now over mortgages, it's over the whole credit environment. It's moved from up to date from 42% to 50%. So there's much more responsible credit going up in the market. This is the typical trend that's taking place in the market, and I think it's important to note this, is if you go and look at the below 5,000 market, you can see it was 13 billion in 2016, and it's now dropped to 8 billion. So it's actually about 5 billion lower. So people are moving out of the below 5,000 market. Remember the banks, and I'm talking ourselves and the 4 traditional banks. We've got about an 80% market share in the unsecured market, and you can definitely see that we actually are pulling out of that higher risk market. I've been the other day in the Vereniging van the Byl area, and what was very clear in the market is, as we're pulling out, your inform or your cash loan business is actually coming in. You're seeing a lot of more of these shops opening up. So we'll see that move in the market taking place. You can see between 5 and 10, it's also dropped from 17 to 14. It's basically flat on the 10 to 15,000, and then growth in the 15,000 plus. So that's actually what's happening in the market, the changes that's taking place. This is in line with what we saw in the market, is that we said that given the economy, that your overtime and your recurring income is going to drop. Recurring income is where bonuses are getting paid to people. And that's why if you look at the NCR, they say that you use an average. Now, if you take a person that month one earns no overtime, month 2, 50 Rand, and month 300 Rand, the average is 50. But what is that person's real overtime income over that period? So we went very conservative. If there's a high volatility, like the example I've mentioned, we've actually ignored overtime. And if you look at the number of applications, you can clearly see what is happening. People earning less than 7,500, the big drop in overtime in their pay slips. And then the people between 7,500 and 10 and 10,000 plus, it's fairly flat. So what you're seeing now in the economy is, I think, 2 things. There's cost pressure, petrol, inflation, exchange rate coming through, and then overtime and bonuses actually dropping. And it's interesting, if you look at what is happening on the overtime side, you can see how big the overtime has actually dropped. And if you compare that to the bonuses, you can see the biggest cutback is on the overtime side, which you can understand, because if there's no demand out there, we see what is happening on the retail side, then you'll expect that the overtime will come through. So it's important to understand what's happening with the client. That's the other big change that we've made. We've deliberately increased our living expenses. The NCR prescribes a table. For a certain income level, you need to use a certain percentage. We've deliberately increased that percentage. So we, on that percentage alone, we're about 20% higher than the NCR. And then what we've done is, on the living expenses, to try and get the real living expense out of a client, he needs now to verify with his biometrics that this is his real living expense. Because what we've seen is that when he goes to a debt counselor, his living expenses is so high, and when he's with us, it's so low. So there's always this anomaly between what he declared and what he says to a debt counselor. So we're forcing people now to actually verify it with biometrics to say this is your expenses and put that onus onto the client. And what you can see here now is, on average, we're now 40% higher than what the NCR is prescribing. So what have we done? We've deliberately cut back in the lower income levels. We've cut back in the small and tiny companies. We've seen more volatility there. We've cut back on the overtime and bonuses side, and we've increased the living expenses. And in that process, you're getting a much more healthier client base. If I look at the outcome of this, as you can see, if we get 100 applicants coming in, we accept now 25. It was in February 23. We've slightly opened up here from about May, June, July. We've opened up slightly, but it's still a very conservative rate that you accept rate is at 25%. And on credit card, I said it yesterday over the media, our accept rate is now about 5%. So it's a very small percentage of the clients that's actually qualifying for the credit card, because for us it's growing that healthy book actually is where the focus is. This is actually what is happening in the book. We've spoken about that if a client actually takes a shorter term, he gets it at a lower interest rate. We go now as low as 12.9%. 21% of our loans is now at a lower term. What is also important is close to 40% of loans that's been provided now is below the 22% interest rate. We would like to get that down to as low as 15% over time. Because if you look at the vehicle finance market, the average interest rate charge on vehicle finance is 15%. So the closer we can get to the 15% with our credit models over time, the more we can actually penetrate the secured market. We stated that we have reduced for about 12% of our sales. We're working on a 20% ROE. Early indications after about 6 months is very positive. Our accept rates is about 4-5% higher. And early indications on your bad rates is that we're actually getting a better bad rate. So you'll probably get a higher ROE than 20%. And we've actually now reduced for about 25% of our sales. Now in October, we're reducing our ROE to between 20 and 25. So bringing that 27% back to 25%. And a big portion of that is actually going into lower interest rates. And then in July and August, we've made changes to our credit policy. We've looked at certain areas and we've opened up slightly. And that's in line with what we said always we'll do. We'll evaluate the credit market on a regular basis, and where we see that we may be too conservative, we will open up. And where we're seeing risk, for example, in the mines, especially in the Rustenburg area, we will close down. And managing that big book on a micro basis. That is just the book. I think the positive side is people with 40% cash available. And just for new people, what we do is we look at our banking clients and we look at their inflow, and then we look at all their debit orders and all their commitments to look at their free cash flow. So what we're saying is, if you look at the book now, 81% of our clients has got a 40% free cash flow. So if there's expenses coming through or unexpected things happening, he's got free cash flow that he can work with. So we're quite happy with the increase. You can see from 74% to 81%. And then you can see on the different levels, you can see what is actually happening, but you can even see on the 15,000 Rand plus, there's a bit of stress coming through from 9% to 15%, but you can see the difference, the 22 versus the 15%. On the lower levels, there's more stress coming through. But I think overall, from a debt to income perspective, we're quite happy that 81% of our clients has got more than a 40% cash flow. Focusing on higher income levels, you can see how the book has switched. This is on loans granted, so that is what we're actually selling. So it's not your book, it's what you're selling. But what you can clearly see now is basically the blue is above 20,000. That's now about 40% of our sales. Between 10 and 20,000 is 40% of our sales, and then below 10,000 is now 20% of our sales. It's also interesting, the debate on the whole debt intervention bill. Everyone is asking what's happening on that. It's going to take, the NCR said it will take 2 years for them to implement. It still needs to go through the provincial parliaments. So it's probably going to take about I would guess 2.5 to 3 years for implementation. And that's that debate. Are you in that below 7,500 market? Are you not in that particular market? Who's your future client? Because if you say no to that client and he goes through the ranks and he gets promoted, you would like to catch that client as quickly as possible. So, and then you're sitting with the reputational risks. So those are the strategic decisions that we will have to make in the next couple of months. But I think what you've seen is we've actually got out of a big time out of that particular market, where out of the short-term market, you can see the 1 to 12-month market, how that has been reduced, and then the increase in the longer-term market. And then you can see on the credit card and the credit facility, the increase in sales. So a switch away from the traditional 1 to 12-month market, looking there at your clients that is healthy, and see how you can build a long-term relationship with those clients, and then focusing more on your higher income clients. There's the credit card figures everyone is looking for. If you look at the credit card, we've got now 360,000 clients on the credit card. So it's grown with about 80,000 clients from February. If you look at the book, 2.6 billion, that gives us about a 2.6% market share. The market is about 100 billion. So the aim is to increase that market share to a substantial portion of the book. What for me is interesting, the changes we've made. You can see here, we started actually the credit card at 50,000, then it was 80,000, and now we've gone up high as 150,000. And for our best clients, we've got now an interest rate of 10%. So I think a very attractive interest rate on that, be able to compete with the other banks. And then for me, the figure that is that you're sitting now with all new credit cards that's been issued, we are doing 30% of the market. So overall, we're happy with the credit card. Then the ones that the accountants has kept us busy with in the last couple of months, especially for Andre and his team, on IFRS 9. We just gave a very short summary on IFRS 9. I think there's a lot of detail in the sense on it. I think 3 things that you need to note for the up-to-date book. We now provide 12-month, so that hasn't changed. For basically everything else, it's basically lifetime. And then the biggest change is we don't write off. Capitec always, at 90 days, we wrote off. So for us, it was nice and clean. Now we need to provide. So you're seeing our book growing now suddenly, but it's actually a 3 billion that's been added because we have to provide on it, and we can't write off. We only start writing off if we believe there's less than a 5% chance that we will actually recover on it. So I think that's the 3 main changes that's actually taking place that you need to look at. I think that is a very nice summary of our performance. You can see the up-to-date book, the increase in the up-to-date book from 37 billion to 39, and then you're sitting with sicker. That's a significant increase in credit risk. I call it just in simple terms, sick clients. Is the clients healthy or are they sick? And you can see, and we're scoring that on our what we grant as well as our behavior model on all our clients. So we score every month now our clients, and we can actually monitor their behavior and see have they got sick, yes or no. You can see there's an improvement on the sicker side. On the arrears side, I think overall you can clearly see the effect of everything we've implemented, that the arrears figures has dropped as well as the rescheduling figures has dropped. You can see the 3 billion there, which is actually what we haven't written off. that we're providing for now. And then you can see the book now is 47 versus 51. But actually, if you take that 3 billion off, we're providing on that 3 billion, we're providing about 92%. So that just gives you a rough feeling. But that's the big changes. I think the message, if I look at these figures, is quite a positive result on our arrears figures and our performance of our clients. The question on provisioning, what we're doing here is just to show the differences between arrears, rescheduled, and write-offs. You can see the difference here between February 18 and August 18 on the write-offs. And you can see the increase here taking place. It's basically just a swap. And then you can see, I think the important thing is to look at the ratios. We covered still 121% on our provisioning, and you can see it's actually a slight increase from 115 to 121. So we're quite happy with our provisioning. We're quite happy with our book performance. Given the economy, I think we've made the right decisions. If I look at the future, everyone is asking us about cream. Cream is, I said to Charles outside, I think there's two ways to go overseas or international. You either go big or you go very small and you learn. Our strategy was to go small and learn. We're learning a lot out of operating in 8 different countries. They're very much in the situation what we were in 2000, 2001. They're operating with 18 brands at very high interest rates, online lending business, and given our experience, what we're saying, you need to have one brand, you need to have term products, and you need to have a much lower interest rate and to operate within. It's interesting, if you go to those particular countries, some of those countries, it's acceptable to lend out at 300%, 400%, 500% per year. So if the one thing we can definitely say, if you look at our regulators, they've done an excellent job of actually regulating our particular market and make it much more sensible. So it's interesting. We've started now with a one brand strategy in Latvia in July. It's still very early. The July-August performance from a sales perspective is very promising, but one will have to look at the rear side to say what the rears is going to look like, because it's one thing cutting prices, but it's the performance that needs to come through. So this is for us a long-term strategy. It's not overnight. It's a learning strategy. So I think the emphasis here is let's learn out of these experiences and slowly but surely building that particular business. I think it links on to, and I'm going to go to the last point on mercantile. Everyone is asking us mercantile. We had long debates, should we go international, should we stay in South Africa? Coming back to South Africa, we believe there's opportunities and the SME market. We actually made a decision last year, October, that we will go into this particular market. So on our merchant side, one of the things that we've picked up is the other banks has got a bank account for that particular client, so they can see this guy is operating out of a Capitec point of sale. There's immediate clearance on the money, so we need to bring in a bank account. So the whole idea was to actually, out of the merchant side, to start developing a business account. On that, we've also started lending to merchants. We've got a book of about close to 20 million. And how it actually works, it's over a 12-month period. And if the person swipes and he buys something, a 5 or 10% is used to actually repay the loan. So we already in this year, we're starting to play in this particular market. And then mercantile comes along. It's not often that you get an opportunity like that. So it's a decision of, do we buy or do we build? We believe there's opportunities in that particular market, so that's the reason for mercantile. Yeah, and I think if we look then at the rest, a very big focus on our people side, on our leadership side, developing our people, making certain their successes, making certain that 14,000 people are fully understanding the why. They're clear on the strategies of the bank. It sounds easy, but to make certain that every single senior manager, et cetera, knows exactly what we want to achieve and what we want to do is a challenge. We always say, if you look at strategies, it's quite easy to formulate a strategy, but implement a strategy. That's where the trick lies, and implement it well. And you can only do it well if your people really knows exactly what's happening. Then on the digital side, we still continue to invest quite heavily in it, and we will continue. If I can get on the digital side, on the big data side, on the artificial intelligence side, if we can appoint another 50 people tomorrow, we'll do it, because there's so much opportunities and work that needs to be done. It's very scarce resources in South Africa. We've started now with our scoring models to start using artificial intelligence. I've mentioned in February that our identifying debit orders on our bank statements, we're using machine learning to do that. So there's a lot of exciting things that's happening in that particular areas. We are definitely using cloud now. Our client profile is actually sitting in the cloud, is sitting in Ireland. And that gives us the ability to actually work much quicker with clients. We've got the ability now to do direct marketing real time with a particular client. So if a client actually draws money at an ATM, we pick it up real time, and we can real time then communicate with that client alternative options. So it gives us that ability to work with our clients much better and actually give them information to make better decisions. I think scalability of work is the other big area. The whole company is on agile. This ability to change. I think if you look at long term, if I look at the companies that's going to win, is the clients that's going to understand their clients' needs the best, and the ability to adapt to that the quickest. And that's what we're working on. And then probably the last one is paperless. It's actually quite interesting. We have switched on a rollout program. By the end of this year, all our branches will be paperless. So when you sign a contract, you will sign it with your fingerprint or biometrically. But it's interesting, on the lending side, there's not a court case yet that actually says a biometric is better than a wet signature. So if you make a cross, they prefer a cross to a biometrics. It's one of those things that you're struggling to understand, but that's the legal term. So we are looking at ways and means, how do we get there? So on our loan side, we'll still wet sign, plus we'll do biometrics, and then try and get a court case to make certain we can legalize that whole process. So yeah, if you look at the next 6 to 8 months, I think the focus will be again on client service in our branches to make certain that we deliver on the promise, delivering on what Capitec stands for. I've challenged our branches to say there's two things that you need to do. The one is to remember you got the brand in your hand, you are Capitec. And the second thing is, given the negative outlook in South Africa and everyone is negative, is to create that positive energy and positive experience in a branch, so that when a client walks out of the branch, that they say there's something different to Capitec. So that's what we will focus on, making certain we get our credit right, and then if mercantile comes through, that will be interesting, because that will keep us busy for so I think there's plenty of opportunities. If I look at the credit market, we've got a 5% market share. We need to get to a 10% market share. We need to be able to attract into the secured market. So we're saying in South Africa, given still what's happening, let's spend our energy on positive things and growing the business. Thank you very much. Any questions? I've got one supporter, I'm paying him.
Just a quick one from me. Maybe comment around.
For the sake of those on the...
Thanks, Gerrie. Just a quick one. So a lot of the non-traditional competitors are looking to get into this lower income market, and I'm thinking specifically about Old Mutual, potentially broadening their product offering into banking. I mean, how would you think about them as a potential competitor?
Well, you've got, if you look at Old Mutual coming into the market, you've got African Bank coming into the market, you've got then Discovery and Time and Bank Zero. So there's a lot of competitors coming into the market. I think we mustn't underestimate Old Mutual. Is they're a very strong brand, and they're very focused in the government sector. They've been very aggressive in the last 3-4 months in the lending side, growing that particular side. So I think competition is good, but I always say the most important thing is understanding the needs of your clients and delivering on those needs. And those are the companies that's winning. Don't focus on your competitors. Understand what they're doing, but focus on the needs of your clients. But we're very aware of what those offerings are.
Hi, Gerrie, it's Charles here from Citi. Just two questions, if I may. The first one is the insurance, funeral insurance profit split with Sanlam. Are you able to disclose that?
No. That's a quick answer.
Thank you. And the second one is the number of businesses or SME businesses that you touch with your point of sale devices. Do you have a sense, or I mean, you've obviously got the data. Can you share?
Well, we've got 30,000 merchants on book.
And what is the percentage of that of the addressable market, I suppose?
The market, it's a difficult market. You don't get a lot of stats, but everyone is guessing there's about 250 to 300,000 merchants out there. Just remember, if we're talking 30,000, what you must be careful is look at the value or a number of point of sale machines. Because if you're in a ShopRite Checkers store, you can easily have 20 or 30 point of sale machines. In a smaller merchant, you'll have 1 or 2. So we're looking at number of merchants. We've got 30,000. And that gives you roughly about a 10% market share.
Thanks. Can you just maybe talk about the outlook for growth on the unsecured lending side, and then also just like potential for new products on the transactional banking side?
Well, on the credit side, like I've mentioned, we've slightly opened up. So we are expecting slight growth. We also are looking at different products to actually enhance our product offer to attack the secured market. So we're working on certain products. I'm not going to elaborate on that. We've learned from credit card that if you promise something, then the market wants to know everything and when you're going to do it. I think on the transactional side, the side that we're working on is what we call value adds. Everyone is asking us, when are we going into loyalty? We're not very big fans of loyalty because loyalty is quite complex and people don't understand it. I still don't understand SAL or BA's loyalty schemes. So we're looking more at value adds. We're working with certain people where if you do something, you get something immediately. So that's a big focus area for ourselves.
Thanks.
That's interesting. No credit questions. Normally we get bombarded with credit questions. Now it was 9 questions. Okay, thank you very much.